All right, well, on that note, here are three things you need to know right now. The macro data comes in thick and fast this week. There's fresh inflation numbers on Wednesday, then retail sales, and the now all-important University of Michigan consumer sentiment reading on Friday. Lots to get into with our first guest, Charles Schwab, Senior Investment Research Manager, Kevin Gordon. Kevin, welcome to the hot seat. Talk us through how bad this earnings season could be, and do you think it's priced into markets?
Probably not fully priced in yet, and I think it gets a little bit more nuanced at a sector and maybe an industry level when you start to get some of the guidance. So I don't know if it's as much the earnings weakness in the second quarter itself, which, yes, we're waiting for estimates to come down. We're waiting for analysts to start to bring down estimates because of what corporations are saying. But I think the story for the rest of the year and probably going into 2023 is going to be how much of the guidance is weak. And again, it's going to be sector by sector because so much of the weakness I think that is still yet to be priced in is probably going to be on the good side. And we're probably going to see the services hit come a little bit later. And the problem with the sort of implosion of the stay-at-home trade was because it got so inflated during the pandemic, and we're still seeing that the air come out of that bubble a little bit. And the question now is how much of that is a hit to not only overall earnings, but the actual economy itself. And now at a time when services demand is starting to weaken a little bit, I just kind of wonder how much we can sort of offset, or whether there is an offset at all, if the goods part is a little bit, of a harder hit from than services is.
Well, even on the good side, it's interesting that you bring that up because we've already had revisions from companies that sell those goods.
Yep.
In other words, a Target, for example, and some of the other retailers that have come out and talked about that. We haven't necessarily seen the feed through to the companies that make the stuff. And indeed, Pepsi today was relatively strong on that basis. So what do you think that process is going to look like for consumer goods stocks?
Well, I think some of it's already been a little bit priced in, but the problem for the market, I would say, in an aggregate sense, so far this year, the whole bear market's been driven by multiple contractions. So we haven't yet seen anything from an earnings weakness perspective. And I think now is kind of the show me moment for it. So we'll see it, sort of phase out over time. But I think, even within kind of, as I was saying, from an industry level perspective and almost a name by name perspective, I think it's going to come down to almost that much of a nuanced basis. Because even when you look at performance for factors or characteristics underneath the surface for the market itself, it's become, dispersion has just kind of said and told us that it's going to be a company by company, sort of data that we have to look at.
How defensive should people be getting with their portfolios right now?
Depends on how you identify or define defense. I think if you're looking at it from a sector-specific perspective, something like consumer staples or utilities, those sectors have actually gotten pretty expensive relative to the market if you're looking on a forward PE or even a trailing PE basis. Our sort of version of defense is kind of looking at it from a factor or a characteristic side of things. And that, for us, looks anything high quality. So anything with a strong dividend yield, strong earnings yield, strong free cash flow, those factors have been the consistent outperformers, not only year to date, but actually over the past maybe 9 to 12 months. And for us, that kind of keeps you out of the sort of sector jumping in, jumping out basis, whether it's month over month or quarter over quarter, and keeps you a little bit more consistent. And you can apply those factors and characteristics to any sector, and it kind of keeps you in gear that way.
Now, sometimes those high quality companies are internationally focused, and I want to come back to the euro and just the general dollar strength across, really across the board. How challenging is that going to be for companies as they're bringing that revenue back to the U.S.?
It is challenging, and that is the hard part with high quality. And this is why it gets actually really, really nuanced, again, by company, because if you're high quality, but you're a large cap multinational, you're feeling more of that hit from the stronger dollar abroad, because 40% of corporate earnings, just in an aggregate sense, come from abroad. So when you break that down and shift it more towards large caps, you get a heavier hit, especially when we have inflation at a multi-decade high and consumers reeling from that. But I think that you have to separate that from strong free cash flow, strong earnings yields, and then just because just it being a large cap multinational or it just being low leverage, that doesn't necessarily mean that it's going to be high quality.
Kevin Gordon, Charles Schwab, Senior Investment Research Manager. Thanks so much for joining us here on Set today. Appreciate it.